Yeah, hello students. So in this presentation, we are going to discuss about overhead allocation. So we have discussed about overhead allocation briefly in the previous video. This video is going to explain what is over application of overheads, what is under application of overhead, and everything in detail. So let's go and start discussing overhead allocation. So we know what is overhead. We already discussed about overheads earlier. So we know what is overhead cost is. So overhead cost is the cost that can't be traced directly to a specific product. This is what actually overhead cost is. For example, factory rent or salary for the supervisor, all this cost we cannot directly trace to the product. And these overheads can be of two type. One is manufacturing overhead, other one is non-manufacturing overheads. So manufacturing overheads are overheads that incurred during the production process, and non-manufacturing overheads are the cost that is not related to your production process. That is the only difference. Okay, so we have two types of overheads, and this manufacturing overhead cost that can be categorized into three normally. One is indirect material. These are materials other than direct material, or this material you cannot trace directly to a product. Then you have indirect labor. These are labor again other than direct labor, and this cost also you cannot trace directly to a product. And then we have your general manufacturing overheads, like rent you paid, maybe property tax you paid, insurance you paid. All these are coming under general manufacturing overheads. So these are the segregation of overheads. I mean manufacturing overhead. So you have indirect material, indirect labor, and general manufacturing overheads. And this we have seen in the previous video also. And overheads again can be fixed and or it can be variable also, or it can be mixed also. So fixed overhead, again we have discussed, this cost is not going to change based on the production. And variable overhead cost, this cost may change based on the level of production. If the production is increasing, this cost is going to change, and when this cost is decreasing, the cost is when the production is decreasing, the cost is going to decrease. An example is electricity or equipment maintenance. The more you use, you will spend more cost on electricity or more cost on maintenance. Less you use, you are going to have less cost. So these are variable overheads. So you have two types of overheads: fixed overheads and variable overheads. Now our question is how we will allocate, or how we will distribute this cost to the number of units what we produced. That is what actually allocation of overhead is. Why this is important? Because there is no direct connection between the production of a unit and this cost. There is no direct relationship, right? You are paying rent if you produce 0 unit, or you produced 100 units, you have to pay the rent. There is no direct connection between this cost and the number of units produced. So what we have to do, we have to take all this cost and we have to allocate this cost to the number of units produced. So what is allocation? It is nothing but, it is just dividing this cost among the units produced. Or we can say, whatever overheads you incurred, you are just distributing the total cost to the number of units produced. And how we will do that we will see in the coming slides. So we know that direct material, we have seen, it can be gone directly to work in process, because we know how much direct material we need to produce each unit, and also we know the cost of the direct material. And situation is same for direct labor also. But overhead cost, this is not incurred for a specific unit, it is incurred in general. So we have to take this cost and we have to distribute the cost towards the number of units we produced. And this must occur so that full cost of the production and operations are known, and this will help you to set a selling price, because if you don't know the total cost of a product, you cannot set a selling price, right? First you have to know what is the total cost of the product, then you will set the selling price. So to set the selling price, you should know the total cost of the production, not just cost of the material and cost of the labor. We have to divide all the cost to the number of units produced, then we will get the total cost per unit, and based on that we can set price for the product. So to do this, what we have to do, we have to find out what is my allocation basis. So in our previous example, in the previous video, we have seen that the total cost we were distributing based on the number of units produced, or we can say our allocation base was number of units produced, or our total cost of overhead we allocated to units based on number of units produced. So we took the total cost and we divided that by number of units, and we got in our previous example $20 as the POR, predetermined overhead rate, right? So here we have to determine what allocation basis we will use, because different cost will have different cost drivers. Okay, so if you take the factory rent, and this need to be allocated to the products what is made in your factory. So you can imagine I'm making product A, product B and product C. So on what basis you will allocate the total rent cost to product A, B and C? We know that it is going to be based on how much space utilized by product A, product B and product C. Another example can be maybe you have insurance expense. Okay, insurance expense normally increasing or decreasing based on the value of the product. So the insurance cost has to be distributed between the products based on the value of product A, product B and product C. Okay, so this is how we will determine what should be our allocation base. Our allocation base is determined based on the cost drivers. What is driving this cost to increase or decrease? And that we are going to consider as allocation base. So normally in every companies you will have multiple allocation base, because every cost you cannot distribute based on just one allocation base. That is going to be wrong, right? Maybe you can imagine you have a factory where you are producing bulky item which is very big in size, and there are some other products that is very small in size. Okay, so you have now two products, and this product which is having big size, that will take more of the more of the factory space, we can say. But imagine that doesn't have much cost. Okay, but it will take a lot of space, and you have a small product that will take a lot of that won't take a lot of space of the factory, but that is costly items. Okay, so now you have two expenses. You have rent. So if you just distribute rent equally to both the product, that is not going to be correct, right? Because one of the product that is bulk in size should get more of the rent, and the product which is small in size has to get less of the rent. Same like the product which is having high value in high valued product, that has to get more of the insurance cost, and product which is having less value should get less of the insurance cost. So it has to be like that. So here we have to determine what is the allocation base for each and every cost. So if the company we have an example here. If the company have very automated process, then you can take machine hours as the allocation base. Whereas if the company is using a lot of labors and the cost is incurred based on how many labors you have, then you can take direct labor hours to divide the cost related to human resource, because in this case you are not using much machine hours. But if you are using a lot of machine hours, or we can say employees are less but you have more machine and you have depreciation, for example, so on what basis you will allocate the depreciation to number of products or different products? It is based on how much machine hours they used. But in another situation, you don't have much machines, more of the work is done by laborers. So how you will allocate the labor cost to the number of or to the multiple products? It is going to be based on how many labor hours spent for each of the product. So if different products produced vary significantly in the number of components, so you have different products and those products are using multiple components, so how you will allocate the total cost? Maybe it is based on the parts or component parts used by each product. So you have to make sure whatever the cost we incurred and the application of that cost has to be justifiable based on the allocation base used by each of the product. So usually a company will divide their overhead into groups, or we call it as pools. So we have different cost related to human resource, different cost related to machine hours. So all the cost related to human hours, it will go here. All the cost related to machine hours, it will go here. So you will have different cost and different cost pool. So then you will take all this cost and divide this cost by number of labor hours, or take all this cost divide by number of machine hours. How is it? That is how it is going to be allocated. So we will go and see how we will do the allocation. To do the allocation, we have to calculate something called predetermined rate. This we have seen in the previous example. It is called as POR, predetermined overhead rate. What is predetermined overhead rate? This is a rate you calculated or you estimated at the beginning of each period. And how you will calculate? You will calculate this by dividing your overhead cost by your allocation base. So I have 100,000 overhead cost and I'm going to spend 100 machine hours, or I'm going to spend 100 labor hours. Then my overhead cost per product is, or per hour in this case, is $1. Okay, so this is how you will calculate predetermined overhead rate. You will take the estimated overhead cost in the beginning and you will take estimated allocation base for the period. The allocation base can be anything. It can be number of units produced, it can be labor hours, it can be machine hours, or it can be anything. It is all up to you how you find this cost can be distributed, and which is going to be justifiable as per your logic. Based on that, you will determine the allocation base. So now here you got $1 as your predetermined overhead rate. Okay, now if everything is going fine, I mean in the sense whatever your estimation was and everything was as per your estimation. For example, in this case you spend $100,000 and you spend 100,000 machine hours. So everything has gone as per your estimation. Then we have no issues. We don't have any variance, or we don't have any over application or under application. But imagine instead of $100,000, the estimated amount of overheads, you spend $110,000. So one side you are spending $110,000 and the other side it is going to be you are applying $100,000 only. So we will go and see the example later. First we will just calculate how a predetermined overhead rate is calculated. So POR is calculated based on budgeted dollar amount of overhead divided by budgeted activity level of allocation base. And this allocation base is also called as denominator level, and we know that both are estimates. Both are estimates we are doing in the beginning. So we can see here an example. So POR is calculated based on this estimated total machine overhead cost divided by estimated direct labor hours. Here allocation base is labor hours, and you got the result here. 3.75 per direct labor hour is our POR. So what does that mean now? $3.75 per direct labor hour, that is our POR. What does that mean? That means every direct labor hour went into production, you will add $3.75 to your production process, or you will add this cost to work in progress. Every time you spend 1 hour of direct labor, you will add 3.75 to your production process, or we can say to work in progress. From where you will be adding this? From our overhead control account. Okay, that we have seen in the previous video. From overhead control account, whenever you spend one labor hour, you will add $3.75 to work in progress. Okay, so this is going to be the journal entry. When you actually spending money, as we have seen earlier, you will debit overhead control account, and it can be credit, can be cash, or accounts payable. So everything it is going to have a debit in overhead control account for whatever the amount you actually spent. You paid rent, you will debit overhead control account, you will credit cash. If you didn't pay rent, you will debit overhead control account, you will credit rent payable. So whatever cost incurred, everything is going to be in overhead control account, whatever actually you spent. And when you are applying this cost from overhead control account to work in progress, you will debit work in progress and you will credit overhead control account. Now you can see there is a debit in overhead control account when you are actually paying, and there is a credit in your overhead control account when you are applying the POR. So all the debit and all the credit is same. There won't be any difference, or there won't be any balance in factory overhead control account, right? Whenever you spend, everything has gone to debit side. Whenever you applied, everything has gone out of overhead control account. So by end of the year, you will not have any balance in the overhead control account. So as we know, overhead control account is a temporary account. That is why it is called as a control account, and it has to be closed out by the end of the period. So every debit, if that is having an equal credit, that means that doesn't have any balance. So it has to be zero balance by the end of the period. But we can see the situation won't be like that. Situation will change, because if your estimate is different from actual, the amount will have difference. Okay, so we have an example here. You are making something and your overhead estimated is $1,000, and you are expecting I will make 50 units for a period. Okay, in an year you are going to make 50 units, and $1,000 is the estimated overhead. So both are estimated. So you can calculate your POR by taking the total cost and dividing that by number of units. Why we are dividing by number of units here? Because here we are considering allocation base as number of units. Okay, and we got $20 per unit. So this is going to be, or this is supposed to be, our overhead rate per unit. Or this is what actually POR, predetermined or estimated overhead rate. Okay, so you are actually expected to spend $1,000 and POR is $20. But actually what happened, your estimation was $1,000, but you actually spent $1,050. Okay, and units of production was as per your estimation. There is no change in that, but actual amount you spent was $1,050. So we will see how this amount is spent in this T account for overhead control, and we will determine how much is applied also. So we can see here, first you have depreciation, that was $500. Okay, so your journal entry is going to be overhead control account to accumulated depreciation, right? So you have $500, then insurance payable, that is $200, and you have rent payable $250, and you have wages payable, which is $250. So total is coming $1,050. But what was your estimation? It was only $1,000. And how you are going to allocate this total $1,000 cost to work in progress? Whenever you made one unit, you will add this $20 to the work in progress. That's what your POR is, right? So whenever you made one unit, you will add this $20 to work in progress. So when you produce 50 units, every unit you produce, you are going to add $20. That means you are going to debit work in progress for $1,000 for every units you produced. But actually how much you spent, $1,050, and how much you applied or how much you transferred to work in progress, it is 1,000 only. So you will have a balance or debit balance in overhead control account, which is 50. That means my spent amount is 1,050 and my transferred amount or applied amount is only 1,000. So I have $50 balance in this overhead control account. Okay, so we can see here 1,000 is going to work in progress account, and actually you spent 1,050. So now you have a balance in overhead control account, and you should not have a balance in overhead control account, right? It has to be transferred to work in progress. Why? You actually spent 1,050 and you are transferring to work in progress only 1,000. So your actual cost, whatever you spend, has not gone to your product cost. That means your product cost is wrong. I spent 1,050, but I applied only 1,000 because application is based on POR and actual spend is here. Or we can say our total cost has not gone to work in progress, or we didn't apply the total cost to the work in progress which we actually spent. Or we can say we applied less or we under applied the total overhead cost. So when there is a debit balance, that means we under applied our overhead cost. Now we can see another situation. In this case, you are actually spending $950 only. Even though your estimation is $1,000 and you are spending only $950. We can take same example here. Here your total cost spend is only $950. If you take this total, that is going to be only $950. But how much it will go? It will go to work in progress 1,000. Why? Because you produced again exactly same 50 units. So every unit you made, $20 will go into work in progress from overhead control account. So now you have a credit of 1,000 and you have a debit of $950. So we can take the total amount here and we will we will minus the actually you spent this $950, and you will see that there is a credit balance of 50. Or what does that mean? I actually spent only $950, but to the work in progress we send $1,000 because 50 multiplied with $20. Again, this costing is also wrong. I actually spent $950 only, but we are adding to our cost $1,000. So we can say we added more or we applied more to the work in progress account or to the production process, or we can say we over applied. For how much? For $50 we over applied. So when there is a credit balance in overhead control account, that means we over applied, or we send more cost to the products compared to what actually we spent. In this case, we spend only $950, but we send to overhead cost, sorry, work in progress account, $1,000. Okay, so when there is a difference in the estimated amount compared to actually you spend, you can have a variance, or you can have overhead which is under applied or over applied. And another factor to calculate POR is the allocation base, right? We were expecting that we are going to produce 50 units, but actually how many units we produced in this example? Only 40. We didn't produce 50 units, we produced only 40. So every unit completed, we will add $20 to work in progress from overhead control account, right? So again, we can go and check the example, same example. We have now $1,000 we spent. And how much will go to work in progress? In the work in progress, we will send only 800. We will send only 800. How? We will take this $20, we will multiply this with 40. So 40 into 20, 800 will go to work in progress. So you have a balance of 200 now, which is not sent to work in progress. But actually you spent $1,000, but you didn't send this $200 to work in progress. Now again there is a difference, because work in progress got only $800, whereas you spent $1,000. Why the work in progress got only 800? Because of the application rate for 40 units. The number of units is different from the estimate. In our previous example, the amount sent was different from the estimate. Now here, the allocation base is different from the estimate. And now you can see you have again a balance of 200 here. You have a debit balance of 200. That means you again under applied, or we can say all the cost has not gone to work in process account. So your overhead is being under applied. So when there is a debit balance in overhead control account, we call it as an under application. I'm sorry, there is a difference in total calculation here. It has to be something different, but assume that the total of this is 1000, because if I stop the video now, I have to start back again. So please excuse me for that mistake. Now again, another hypothetical situation. Your estimation was 50, right? But I produced 60. So what does that mean? Whenever I produced one unit, I will send $20 to my work in progress. So I produced 60 units, whereas my estimation was only 50 units. Again, we will see this example. You produced 60 units. So every time you make one unit, $20 you will send to work in progress. $20 you will send to work in progress. So whenever you produce 60 units, so every time $20 means 1200 it will go to work in progress. Okay, and but actually how much you spend? you spend, again imagine the total of this is 1000. There is a mistake of $100, but imagine that is 1000. So you will have a difference of $200. Correct? Actually you spend only 1000 and you transfer to work in progress 1200. So that means you added more cost to work in progress. Why? Because every time one unit is produced, this $20 is added to work in progress. So $1200 is applied to work in progress, whereas you spend actually only 1000, and you have a difference of $200 here, which we call it as over application, because it is having a credit balance, or we can say credit balance. Why it is increased? Because we applied more than what we spent. So now you understood there is a chance of over application and under application of overheads based on two things. What are the things? Based on what is the cost difference between estimate and actual, and what is the allocation base or quantity of allocation base difference between estimated and actual. So both of these will create a difference. It can be under application or it can be over application. Okay, I hope you understand what is over application, or what is over applied overhead, or what is under application is with this example. And I will stop this video here, and we will discuss the rest of the things in the coming video. Thanks a lot for watching, and thanks a lot for being with me.